America owes $39 trillion. If you spend $1 million every single day, starting the moment Jesus Christ was born, you still wouldn't reach $1 trillion. That's not even 2% of what's on the books right now. It works out to roughly $114,000 owed for every single American alive today. You've been told this is fine. You've been told it's backed by the full faith and credit of the US government. You've been told the dollar is king and always will be. You've been lied to. The dollar isn't held up by faith. It's held up by a system that forces the entire world to keep using it just to survive. A system invented in secret, negotiated in private, and now it is cracking. When it breaks, it doesn't happen to them. It happens to you. If you already feel like something is deeply wrong with the financial system but nobody can explain exactly what, hit the like button right now. This video is for you. Now let's actually explain it. I spent the better part of 8 months going through declassified US Treasury documents, Federal Reserve reports, BIS working papers from Basel, IMF reserve currency data going back to 1944, and 4 books most financial journalists never actually finish. What I'm about to show you took economists decades to figure out, and governments decades more to admit. The 1974 arrangement I'm going to describe stayed partially classified for over 40 years. It was only publicly confirmed in 2016. I've distilled all of that down into the next 10 minutes. Pay attention. Here's the mental model that will make all of this click. I call it the petrodollar toll booth. Imagine a highway. It's the only road that connects every country in the world to the energy they need to survive. Every truck, every car, every single vehicle that wants to pass through has to pay the toll. The toll? American dollars. It doesn't matter if you're Japan, India, Germany, or Brazil. You need oil. Oil is priced in dollars. So you need dollars first. You go buy dollars. The US collects the toll invisibly every single time. That demand for dollars is what allows the US to print trillions without immediately destroying every paycheck in America. The inflation gets exported. The rest of the world absorbs it. The only reason your groceries aren't twice as expensive right now is because central banks in Tokyo, Frankfurt, New Delhi, and Seoul are soaking up trillions of American dollars each year just to pay their energy bills. That's the toll booth. Now, somebody is building a road around it. The US dollar appears in nearly 90% of all foreign exchange transactions on Earth. 9 out of 10 times a currency changes hands anywhere on this planet. One of those currencies is the dollar. The Earth has 180 national currencies. The dollar is the operating system that all the others run on. What built this? One mechanism, hiding in plain sight: the global oil market. The global oil market is worth approximately $2.5 trillion per year. In physical terms, it's larger than the combined market value of gold, iron ore, copper, aluminum, nickel, zinc, lead, tin, cobalt, and lithium, all of them together. Oil is the single largest traded good in human history. And for 50 years, nearly all of it had to be purchased in American dollars. A Japanese company buying Saudi oil first converts yen to dollars. French refineries importing Kuwaiti crude first buy dollars. Indian power plants importing Iraqi oil first buy dollars. That demand is constant. That demand is enormous. And that demand is what the entire US financial system is built on. It's quietly coming apart. To understand how we got here, you need to go back to 1944. After World War II, the world needed a financial system. America stepped in with a clear offer. 44 countries gathered in Bretton Woods, New Hampshire. The deal: peg your currency to the dollar. The dollar gets pegged to gold at $35 an ounce. Every dollar is a claim on something real. For 20 years, it worked beautifully. Then came Vietnam, the Great Society, the space race, a defense budget that would make a Las Vegas high roller blush. By the late 1960s, the US was printing dollars faster than it had gold to back them. The Europeans, the French specifically, started doing the math. They looked at how many dollars were in circulation. Then they looked at America's gold reserves. The numbers didn't add up, so they started cashing out. Literally, they loaded dollars onto planes and ships. Over 3 years, France repatriated over 3,000 tons of gold to its own vaults. Other countries followed. America's gold reserves, once 80% of the world's supply, started draining fast. By 1971, the jig was up. Richard Nixon went on television and, without a vote, without warning, closed the gold window. No more converting dollars to gold. He canceled Bretton Woods unilaterally. The Americans called it the Nixon shock. The French called it several things that don't translate politely. The global system, previously tied to something real, was now built on a vague sense of trust that America would behave responsibly. Given the preceding decade, that was a lot to ask. Then, in October 1973, the Arab members of OPEC declared an oil embargo. Prices quadrupled, gas stations ran dry, Americans lined up around city blocks just hoping to fill their tanks. Enter Henry Kissinger. Kissinger, depending on your perspective, was either a master strategist or a war criminal with excellent table manners. What he undeniably was effective, something in short supply in 1974. His idea was almost absurd in its simplicity. If you can't back the dollar with gold, back it with oil, something every single country needs every single day. He went to Saudi Arabia publicly to discuss infrastructure. Behind closed doors, the real deal took shape. Saudi Arabia would sell its oil exclusively in US dollars. Every country on earth that needed oil would first need dollars to get it. In exchange, the US guaranteed Saudi Arabia's security. The Saudis got the most powerful bodyguard in history. America got its monetary mojo back. Within a year, every major oil producer followed. No grand summit, no global vote. Saudi Arabia moved, it made sense, everyone fell in line. The deal that quietly determined the price of energy, housing, and groceries for half a century wasn't publicly confirmed until 2016. What Kissinger built did something remarkable. It took America's greatest vulnerability, a currency backed by nothing physical, and turned it into its greatest strategic weapon. Once oil was priced in dollars, countries didn't spend their dollar reserves. They held them. And when they held them, they invested them, mostly in US Treasury bonds. Every time a foreign government bought American debt, they were effectively financing Washington. The US built highways, funded wars, expanded its military, and won the Cold War, while the rest of the world helped pay the bill. The toll booth held for 50 years. Then China decided to build a road around it. China currently imports nearly 2 million barrels of oil per day from Saudi Arabia alone. That's enough crude to fill approximately 127 Olympic swimming pools every 24 hours. China is now Saudi Arabia's single largest customer, and for years it's paid for all of that oil in dollars. But in 2021, something shifted. A project launched out of Basel, Switzerland, from the Bank for International Settlements. It's called M-Bridge, the Multiple Central Bank Digital Currency Bridge. The name is forgettable. The idea is not. M-Bridge lets countries move money directly between each other using digital currencies issued by their own central banks. It bypasses intermediaries, it bypasses SWIFT, and most critically, it bypasses US oversight. Here's why that matters. Today, if Thailand wants to send money to China, it bounces through a chain of Western banks and settles in dollars using SWIFT, a system that processes $5 trillion a day and operates under Western influence, which means it can be weaponized, and it has been. When Russia invaded Ukraine in February 2022, the G7 kicked Russian banks out of SWIFT and froze approximately $300 billion in Russian reserves overnight. If you're another government watching that, if you're China, India, or Saudi Arabia, you start asking one question. What happens if we're next? China didn't write a strongly worded letter. It built an exit. M-Bridge went live in 2024. By late 2025, it had processed over 4,000 transactions worth $55 billion, a massive leap from its pilot tests. Still small, but it wasn't designed to replace SWIFT on day one. It was designed so countries never have to ask the West's permission to transact. America's financial nuclear weapon, the ability to cut any country off from the global economy, no longer looks unavoidable. Before we go further, check the pinned comment below. I've linked a free breakdown of the exact BRICS payment systems being built right now and what they mean for your savings. Go grab it. In June 2024, news exploded claiming Saudi Arabia had officially ended its petrodollar agreement. The deal was dead. Dollars over. Pack the bags. Here's the truth. There was never one legally binding contract to expire. The 1974 bilateral economic agreement had technically lapsed in 2001. The petrodollar system was never a treaty. It was a self-reinforcing habit baked into the architecture of global trade. But that system is unraveling, one yuan-denominated oil transaction at a time. Economist Zoltan Pozsar, one of the most watched macro analysts on earth, called this transition Bretton Woods III. His argument, the world is shifting from paper claims on governments to physical assets like gold and commodities. His punchline, commodities are collateral, and collateral is money. When the G7 froze Russia's reserves, it didn't just punish Russia. It told every non-Western central bank on earth that dollar-denominated assets could be confiscated. That changed the calculation permanently. The dollar's share of global reserves has dropped from around 85% in the 1970s to roughly 58% today. Sure, it took 50 years, but that 58%, it's the lowest it's been in 2 decades. And here's where this lands in your real life. The US government currently pays over $1 trillion a year just in interest on its debt. That's more than the entire defense and education budgets combined. That number stays manageable because foreign governments keep buying US Treasury bonds. More buyers means higher bond prices, lower yields, lower interest rates. And mortgage rates track Treasury yields almost exactly. When rates moved from 2.65% to 7.79% between 2021 and 2023, the monthly payment on a $400,000 mortgage jumped by almost $1,300. Now imagine that move wasn't driven by deliberate Fed policy. Imagine it was driven by fewer countries needing to buy dollars for oil and therefore fewer countries buying treasuries. Bond prices fall, yields rise, mortgage rates follow. The Fed can cut its federal funds rate all at once, but it cannot force central banks to keep absorbing American debt. If they stop, the bill lands on you. Every global reserve currency in history has eventually lost that status. Every single one. The Roman denarius, the Dutch guilder, the British pound sterling. Each was, in its era, the operating system of global commerce. Each one fell when the economic logic that made everyone want it slowly stopped being true. When Britain finally lost reserve currency status, it didn't collapse in one apocalyptic moment. It went through decades of inflation, emergency IMF bailouts, and a standard of living that steadily declined relative to the rest of the developed world. The pound slowly became less relevant. British citizens absorbed the cost in ways that never quite made a single front page. That's the template for the dollar today. The US is not Britain in 1945. The dollar is vastly more embedded in global finance than sterling ever was. But the pattern is the same. Build global demand for your currency, then watch that demand erode. Here's where things stand right now. In 2026, BRICS represents nearly 36% of global GDP and 44% of global oil production. mBridge is live. CEPs, China's alternative to SWIFT, connects 109 countries. India is buying Russian oil in yuan and rupees. Brazil and China have ditched the dollar in their bilateral trade. Saudi Arabia is conducting transactions on mBridge while simultaneously declining to formally join BRICS. That last part matters. That's not a mistake. That's strategic ambiguity. That's a country keeping its options open. None of these systems are the dollar. None of them replace SWIFT on their own. But the dollar didn't take over the world overnight either. It won because the rules were simple. The world runs on oil, and oil is priced in dollars. So if you wanted energy, you needed dollars. That's the part that's starting to crack. America's $39 trillion debt only works because the rest of the world keeps needing dollars. The real question isn't whether China builds a perfect alternative. It's what happens when the world decides that what's been built is good enough and starts moving those trillions somewhere else. Because when that shift actually begins, it doesn't stay contained to currency markets. It spills into interest rates, into asset prices, into mortgage payments, into the price of groceries. And at that point, the system doesn't slowly adjust. It snaps. And at that point, the question becomes, what actually happens when it does? We explore that in full in the next video. What a US economic crash actually looks like step by step from currency markets all the way to your bank account. It's right there. Watch it next.